Mr. Buffett, how can I make $30 billion?
Start young.
How did Warren Buffett actually become rich? We all know his story, where he began investing at the age of 11 back in 1942. Since then, he has grown, becoming a walking financial book people often try to read. However, in doing so, they make the exact mistakes Warren Buffett tried to avoid, trying to break limits and doing exceptional things. Yet, investing is simple if you keep it simple.
You don't have to do, we've said this before, but you don't have to do exceptional things to get exceptional results. And some people think that if you jump over a 7-foot bar, that the ribbon they pin on you is going to be worth more money than if you step over a 1-foot bar. And it just isn't true in the investment world at all. So you can do very ordinary things. I mean, what is complicated about this? But, you know, we're $3 billion pre-tax better off than we were a few years ago because of it. There's nothing that I know about that product or its distribution system, its finances, or anything that really hundreds of thousands or millions of people aren't capable of, that they don't already know. They just don't do anything about it.
What if you could copy Warren Buffett or simply ask him how to get rich in 2024? Well, he has answered this, offering the simplest investing philosophy on the planet. That's the same strategy with which he accumulated his wealth, becoming a man with $122 billion net worth. So, what exactly should you do in 2024 to become rich? Watch the video until the end to get the essence of Warren Buffett's career wisdom. Let's get started.
So I would say if you're working with a small sum of money and you're really interested in the business and willing to do the work, you will find something. If you were, there's no question about it in my mind. You will find some things that promise very large returns compared to what we will be able to deliver with large sums of money.
Number 1. Avoid get-rich-quick schemes. You have two options in your life. You can choose to fall for the getting-rich schemes and trending things, or stick with a tried and tested method. In other words, you can rely on luck, but there are fewer chances of that luck turning in your favor. On the other hand, you can stick with what Warren Buffett did, and there are more chances of your success. In other words, if people try, more of them can become Warren Buffetts than Elon Musk or Mark Zuckerberg. The reason is simple. Warren Buffett did what even an ordinary man can do, just by following some strategies. But to be Elon Musk, you have to go with the trend and take risks, which not everyone can afford.
You don't need tons of IQ in this business. I mean, you have to have enough IQ to get from here to downtown Omaha, but you do not have to be able to play three-dimensional chess or be in the top leagues in terms of bridge playing or something of the sort. You need a stable personality. You need a temperament that neither derives great pleasure from being with the crowd or against the crowd. Because this is not a business where you take polls, it's a business where you think.
But should you immediately sell your stocks if they decline? You will find what Warren Buffett has to say on that in a few seconds. Buffett never followed the latest trends. His life is a product of it. That's why he took almost 72 years to reach where Elon Musk reached in less than a decade. Number 2. Start young. The more time you give your money to grow, the more it will grow. That's a law no one can break or bend. According to Buffett, the key is to start your investment venture early to capitalize on the advantages of compound interest. Buffett clearly said you have two options: start investing very young or live to be very old.
Mr. Buffett, how can I make $30 billion?
Start young. Charlie's always said that the big thing about it is we started building this little snowball on top of a very long hill. So we started at a very early age in rolling the snowball down. And of course, the snowball, the nature of compound interest is it behaves like a snowball of sticky snow. And the trick is to have a very long hill, which means either starting very young or living to be very old.
Number 3. Don't let stock declines cause stress. If you've invested money in stocks and you are seeing prices every hour, this won't work for you. Buffett advises against making impulsive decisions when your stock experiences a decline. In an interview with CNBC, he stated, "If you're going to do foolish things because your stock goes down, then you shouldn't own stock at all." By foolish things, he clarified he means selling your stock solely because its price has decreased.
Investing, if I'm going to buy a half interest in a McDonald's stand and you're going to run it, or a McDonald's franchise and you're going to run it, I look to the business to determine whether I've made a good investment. And I'm concerned about, whether we have new competition, how we do over the years, but it's the business I look at. When you're just looking at the price of something, you're not investing. I mean, if you buy something, Bitcoin, for example, or some cryptocurrency, you're not looking to the asset itself to produce anything.
Buffett acknowledges that stocks will inevitably experience declines at times, but he advises not to worry about it. His perspective is to buy something you like at a price you find attractive and then hold onto it for a significant period, preferably 20 years. He discourages monitoring stocks on a day-to-day basis, likening them to owning a farm or an apartment house, where you wouldn't check the value every day, week, or month. According to Buffett, the key is to view stocks as long-term investments rather than reacting to short-term market fluctuations. Number 4. Invest in small companies. Where you will invest depends on where you stand. If you have millions of dollars, you can invest in assets that have already grown enough. You can take chances and afford not to make profit. However, according to Warren Buffett, you should invest in small companies if you are starting new. It's because these companies are yet to grow, and when they will grow, so will you.
Market.
You can buy small pieces of businesses for less than you can buy whole pieces of businesses.
For the premium you'd have to pay if you were buying the whole thing.
So you get a bargain as an investor compared to what I can get in terms of buying the whole business. And people, if they just think of stocks as pieces of business, they'd be so much better off than thinking of them as little things that move around in price. And
something should be understood here. The percentage of the growth in stock prices of small companies will always be higher than that of the companies that have already witnessed their fame. That's a simple rule. However, that does not mean you should invest in every small company you put your eyes on. Buffett underscores that the key to growing your wealth lies in investing in sound businesses by acquiring pieces of them, specifically stocks, at attractive prices. In a hypothetical scenario where someone is just starting with $10,000, Buffett suggests beginning by examining companies alphabetically, starting with those whose names begin with A and moving down the list. The focus should be on smaller companies to identify promising investment opportunities. Number 5. Embracing the principles of value investing. Buffett's wealth has been built on the principles of value investing, a strategy he learned in college from Graham. Value investing involves investing money into undervalued companies with growth potential and holding onto them long term. It becomes a sort of law that will, in all cases, grow. Unless all markets are bent, undervalued companies, given sufficient time to grow, will bring huge profits for investors who are just starting.
I know what markets are going to do over a long period of time. They're going to go up. But in terms of what's going to happen in a day or a week or a month or a year even, I've never felt that I knew it.
Number 6. Buy during market downturns. Buffett is known for advising to be fearful when others are greedy, and to be greedy when others are fearful. He has a history of seizing opportunities during market crashes or overcorrections, buying companies below their true value with confidence in their eventual recovery. Greed doesn't drive him to invest in a stock or company simply because it's the latest trend or everyone is jumping on the bandwagon.
anytime stocks go down, as far as I'm concerned, I like it because I'm a net buyer of stocks. I've been buying stocks ever since I was 11 years old. So when stocks go down, it's good news. Just like when hamburgers go down, it's good news, or Coca-Cola goes down, it's good news in terms of anything I buy. But you know, stocks are going to go down. You could probably look it up as to what percent of the days of the, since I was born, they've gone down. And
would you like to try Warren Buffett's strategies in 2024 and get rich? Wouldn't it be interesting to see whether these strategies work if you precisely do what Warren Buffett said? In the comment section right below, let us know whether you agree with Warren Buffett on wealth building. Also, subscribe to our channel if you'd like to watch more videos like this, giving you important financial updates that matter. Thanks for watching.